Hey guys, Dave Keller here with Market Misbehavior. A couple times earlier this year, we've done a choose your own adventure style analysis of the S&P 500. We've listed out 4 potential scenarios and have you voted on which one you think is most likely and why. We're doing it again today. We will have the very bullish, the somewhat bullish, the mildly bearish, and the very bearish scenarios. Listen to each of them and then vote on which one you see is most likely and why. So I love this sort of analysis. It's a choose your own adventure style analysis, really a probabilistic outcome, a set of probabilistic outcomes, thinking about 4 different scenarios. Now, part of this is to think about which you think is most likely, right? Out of these 4 scenarios, which do you feel is most likely to play out? But it's also to force ourselves to think about a bunch of other scenarios, right? You have sort of that narrative, sort of that most likely investment thesis that makes sense to you, but you also want to make sure as an investor you think about some alternative hypotheses, right? What are some other things that could happen? What would happen to your portfolio if a very bearish scenario or a very bullish scenario would actually play out, right? And thinking about how you would manage risk or how you would jump on potential opportunities given those alternate hypotheses. That's a sort of analysis or a sort of investment process that institutional investors often will go through, thinking about different potential outcomes. And I find individual investors and financial advisors could do much better thinking about those potential outcomes. Before we get to the chart and the 4 outcomes, though, I want to remind you, if you like this sort of thinking about market history, market dynamics, and investor psychology and technical analysis, if that's of interest to you, I hope you'll subscribe to my channel. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Finally, don't forget to put a comment below. Which of these 4 scenarios do you see as most likely and why? Let's get to the chart. All right, so here's a daily chart of the S&P 500 going back about 1 year. And just to set the stage for what we're looking at here, you probably know what the S&P looks like, but just to review, we have the new high going into January. Again, a lot of stocks, the NASDAQ, other places topped out in November, but the S&P actually made a new high going into the beginning of January. From there, we had the sell-off in the first quarter, the rebound, and this was a key rebound in March where we tested the previous high, got barely above it, and then rolled back below, eventually making a new low for the year in May and again in June. So far, the low for the year has been in mid-June. From there, we've had a pretty decent move higher, 10, 15, 20% of a rebound, depending on what you're looking at, and obviously everything in between. But, in general, nice bounce off the lows, S&P bouncing about 15% off of the lows. Now, once again, the previous swing high is in play. We've gone a couple days above that June high, and we're testing that 4,200 level here in early August. So here are the 4 different scenarios. Scenario 1, the very bullish scenario. This would basically mean regaining 4,600, which was the high from February and also the high from March. Can we retest those highs? And I think the very bullish scenario involves getting through those highs. And this would be in the next 4 to 6 weeks, we'll call it. To get to that point, the S&P would have to continue in a very similar trajectory to what we've seen so far. It's been a fairly vertical rise from mid-June to mid-August, really driven by growth stocks. Now, what's happened in the last week or so is you've seen energy stocks starting to recoup a little bit, industrials, materials, sort of the MEI trade starting to appreciate as well. So you'd most likely in that scenario, what would cause that to happen? You'd have to have interest rates probably remain muted, which means even though the Fed is raising the lower end of the curve, the longer end of the curve stays relatively stable, flat to down. That would give room for growth stocks certainly to appreciate from here. And you'd really have to see a continuation of everything that drove the S&P and the NASDAQ from mid-June to mid-August would have to continue. We'd have to continue that acceleration going to the upside to get to 4,600 in the next 4 to 6 weeks. So that's the very bullish scenario, basically leading back to the February, March highs, if not going a little further. Scenario 2 is more of the we'll call it the mildly bullish scenario. Scenario 2 would basically mean we get up to the 61.8% level, but we don't really get up to the 4,600 level. We don't retest those February or March highs, but we get above current levels, right? Sort of eclipse 4,400, we'll call it. And we sort of, in the next 4 to 6 weeks, end up in the 4,400 to 4,600 range. That would be could be a pullback of sorts, but then the market goes higher. So the number one, the bullish scenario, is almost a continuation of the current trajectory. The second scenario, the mildly bullish, means probably a pullback from current levels, but we rebound very quickly and just continue that upward move. And 4 to 6 weeks from now, we're still very much in a short-term and medium-term bullish phase. So the S&P ends, we'll call it 4350, 4400, up to 4600. The mildly bearish scenario is basically we don't get much above current levels, sort of this level around the 50% retracement, which is around 4230, 4200, which is the upper end of the range we've been talking about a lot on StockCharts TV. Let's say we stall out at current levels, we pull back, and we never really get above 4200, 4250. So the 50% retracement is pretty much it. We probably chop around here quite a bit. What would cause that to happen? Well, that would be interest rates actually move back higher, right? Instead of the 10-year yield, which came back from 4.25, sort of, 3.25 back down below 3%, maybe goes up a little bit, right? Gets back and retests those highs from 2018 around 3.25. That would make it very difficult for growth stocks to appreciate. And most likely you get stocks sort of chopping around. In this scenario, also high yield spreads would most likely widen a little bit. The VIX would increase because volatility starts to elevate again, and you get basically a choppy period for the next 4 to 6 weeks. That would prevent stocks from going materially higher from current levels. And today's sort of the high water market where we're in. We sort of chop around in this range. That leaves us with the fourth and the very bearish scenario. And quite simply, that's a retest of the lows. 3650, maybe even 3600, maybe undercutting the lows. And not necessarily by a significant degree, although that maybe is the ultra bearish scenario. It might be scenario 5, like the doomsday scenario. Probably unlikely here, though, right? The scenario 4, the very bearish scenario, basically means a retest of the June lows is what happens. And again, it doesn't necessarily have to be a straight line. You could sell off and retrace a little bit and sort of get down there, but it would have to sort of revert to the downside very, very quickly. What would happen there is the rally that we've seen from mid-June to mid-August is it. All of these technology names that are overbought here in early August take that to heart. They pull back, and it's not just a pullback, but you see further deterioration. We re-engage those bear market narratives of higher rates. We get information suggesting inflation is not transitory again. It's once again sort of continuing to be a huge impact on consumers, and as a result, weighs heavily on the S&P 500. I think those are the 4 scenarios I would want to lay out. And just to review, because I went through them pretty quickly, I was actually materializing this, I was solidifying them in my head as I'm talking. So just to review the 4. Scenario 1 is the very bullish scenario. That would basically mean a fairly continued trajectory from what we've seen so far. Now, again, you could have some pullbacks along the way, but overall, the net movement is positive because in 4 to 6 weeks to get above 4,600, you really have to make up some ground and continue to push to the upside. Scenario 2 is the mildly bullish scenario, which means we don't get much below current levels, maybe briefly, but you have to continue that uptrend. And again, the mildly bullish scenario would probably mean interest rates can't go much higher than where they are right now, maybe a little, but you'd probably have to keep interest rates fairly low to give the S&P and the NASDAQ room to move higher from here. And that would end us sort of in that 4,400 to 4,600 range. The third scenario, the mildly bearish scenario, means we may go a little bit further, but not much, right? You don't get much above current levels. 4,200, 4,250, probably the ceiling for this move. We pull back a little bit and sort of end that period sort of chopping around the 4,000, 4,200 range. This would be more of a backing and filling type of scenario, the mildly bearish. So it doesn't mean that we can't end the year higher. It just means for now we've run up quite a lot. In this scenario, that third scenario, the mildly bearish scenario, I would expect the dollar to probably strengthen again, which would make it difficult for most likely would coincide with rates going back to the upside, which would most likely make it very difficult for growth stocks that have led so well coming out of the June lows. It would prevent them from really providing further leadership to the upside. The fourth scenario, the very bearish scenario, that would basically mean we've certainly stalled out here. We pull back, but instead of pulling back and reverting higher, which would be the second and third scenarios would probably play out that way, That fourth scenario would be basically mean a brief bounce before reverting and retesting the lows. If you hear people talk about the seasonal headwinds that we're entering into, August, September, October actually tend to be seasonally pretty weak for the technology sector. So that fourth scenario would basically mean the seasonal trends really take hold. A lot of the bearish narratives that dominated the markets in the first 6 months of the year, this was a brief vacation from those over the last 2 months. Those all re-engage, and we're all worried about inflation. We're worried about the Fed being more hawkish than we've seen, and basically the light at the end of the tunnel recedes further off into the distance as it feels further and further away. Now, what's interesting to wrap up here is all four of those scenarios are possible. And I think that's the important thing to remember here. Every one of these, from the very bullish scenario to the very bearish scenario, is 100% possible. The question is, which one is most probable? And that's what I want you to think about here today. So there we go. We have the four scenarios. The very bullish scenario, which takes the S&P near it certainly takes it to 4,600, the March high, and even goes a little bit further than that with all-time highs not too far off. The mildly bullish scenario, scenario 2, involves us going a little bit further to the upside, but not really ever regaining that 4,600 level. We don't really make it past the March high or really put that one in play. The third scenario is the mildly bearish scenario. That would involve sort of limited upside from here and more backing and filling between current levels around 4,200, 4,250 and back into that 3,900, 4,000 range. The very bearish scenario, scenario 4, would be a move back to the low for 2022, and we get down to 3,700, 3,650, even 3,600. We could even briefly undercut the June low. Which of those four scenarios do you see as most likely and why? Let me know in the comments below. But also, as you're doing it, before you vote, make sure you think about all four of them. And that is really the essence of this video. It's not enough to just pick a thesis and stick with it and ignore all the evidence. The point of probabilistic analysis is to think about different scenarios. Think about an alternative hypothesis to what you see as most likely. Think about what the markets would do in that scenario. Think about what the macro conditions, how they might evolve, what news headlines you'd be reading that would reinforce that thesis. And most importantly, think about what your portfolio would do in the very bullish scenario, the mildly bullish, the mildly bearish, and the very bearish scenario. By thinking about what your portfolio would do, how you would manage risk, how you would manage opportunities, what that will empower you to do is take action if and when you see one of those four scenarios actually playing out in real life. From Record Misbehavior, I'm Dave Keller. Stay safe and be well, and we'll see you again next time.